Welcome back to Am I Catching a Falling Knife? The podcast where we break down what's really driving the markets and whether that recent dip is an opportunity or a warning sign. I'm your host, Dave, and today we're putting a true American icon under the microscope, General Motors, ticker symbol GM. This stock has taken a bit of a tumble recently, dropping over 6% in just the last 10 days. So, is GM a bargain in the making, or are we about to grab a very sharp blade? Let's find out. All right, let's dive into GM, ticker symbol GM, which has seen its stock price drop by 6.32% over the last 10 days. So, what's the story here? Well, the market is currently buzzing, or perhaps more accurately groaning, about one single dominant narrative driving GM's price action: the significant financial burden of tariffs. Despite actually exceeding Q2 revenue and earnings estimates, GM's profit took a noticeable plunge. Why? A hefty $1.1 billion tariff hit. And the bad news doesn't stop there. Management has warned of an increased impact for Q3, with an estimated $4 to $5 billion impact projected for 2025. That's a huge number, folks. So let's start with some fundamentals. GM is an American multinational automotive manufacturing giant. They design, build, and sell trucks, crossovers, cars, and automotive parts all around the globe. You probably know their main brands: Chevrolet, Buick, GMC, and Cadillac. They also have their financing arm, GM Financial, which accounts for about 8.5% of their revenue. North America is their bread and butter, bringing in nearly 84% of their sales, with the U.S. alone making up over 81% of their total revenue. Beyond their traditional business, GM is making significant investments in the future, especially in electric vehicles, or EVs, and autonomous vehicle technology, like their Cruise segment, which, while tiny at 0.14% of revenue today, represents a big bet on tomorrow. They've even got a stated goal of achieving carbon neutrality by 2040 and aiming to end internal combustion engine vehicle production by 2035. Financially, they pulled in $171.84 billion in revenue last year, but their free cash flow is currently negative at $2.88 billion, and they carry a substantial $134.2 billion in total debt. Now let's get into the numbers. So, how did we get to that tariff impact number we just mentioned? Let's break it down step by step. First, the narrative explicitly told us about a $1.1 billion tariff hit in Q2, which, as we noted, caused GM's profit to plunge. This wasn't a hidden cost, it was right there. Second, to figure out the relative impact, we needed a baseline. GM's latest annual revenue is about $171.84 billion. If we divide that by 4 for an average quarter, we get roughly $42.96 billion. Then, assuming a typical 8% operating income margin for a large industrial company like GM, we estimated a hypothetical pre-tariff quarterly operating income baseline of about $3.44 billion. That's our starting point before the tariffs started eating into their bottom line. Third, the narrative also warned us about an increased impact in Q3. We made an assumption here, estimating a moderate 18% increase from that Q2 tariff hit. So we took that $1.1 billion, multiplied it by 1.18, and that gave us an estimated tariff burden for Q3 of roughly $1.30 billion. And finally, to get the percentage impact on Q3 quarterly earnings, we took that estimated Q3 tariff burden of $1.30 billion and divided it by our hypothetical pre-tariff quarterly operating income baseline of $3.44 billion. Multiply that by 100% and boom, we landed on an estimated negative impact of about 37.79%, which we've rounded to a pretty significant 38% hit to their quarterly earnings just from these tariffs. Now, it's important to remember this estimate has a confidence interval between a 30% and 45% negative impact, because we had to estimate that pre-tariff earnings baseline and make an assumption about the Q3 increase. This analysis focuses purely on the tariff story. So, what does this all mean for GM's valuation? To get a fair value, I ran a discounted cash flow, or DCF model, using some standard assumptions. We're looking at a growth rate of 1.77% over the next 5 years, which is GM's expected EPS growth. Our discount rate, which accounts for the risk, is set at 9.5%, and we used a terminal growth rate of 2.5%. With these inputs, our base case value for GM comes in at roughly $89.54 per share. That's what a classic DCF model suggests GM could be worth without considering these significant tariff headwinds. However, when we factor in the persistent and increasing tariff burden we just talked about, applying that narrative's impact, our fair value estimate for GM comes down significantly to about $49.25 per share. Compare that to GM's current price of around $48.89 and an analyst target price of $56. So, given this picture, what might be some levels to consider if you're looking to catch this potential falling knife? My custom buy levels for GM are $42, then $35, and for a deeper value play, $27. All right, that wraps up our deep dive into General Motors. Remember, all of this is for informational purposes only and is not financial advice. Investing involves risk, and you should always do your own thorough research and consult with a financial professional before making any investment decisions. Thanks for tuning in to Am I Catching a Falling Knife? I'm Dave, and I'll catch you next time.